Okay, we're beginning the reading using multi-factor models. We don't have a lot to get through, rather short, I think 11 screens here, but we're going to go through quite a few of the examples. LOSA, describe arbitrage pricing theory, including its underlying assumptions and its relation to multi-factor models. And to understand arbitrage pricing theory, we first have to get our head around what a factor is, what a multi-factor model is, and the idea of financial market equilibrium. Once we have that, we'll understand arbitrage pricing theory. So a factor is a variable or a characteristic with which individual asset returns are correlated. And we've all seen at least a single factor model to this point, which is the capital asset pricing model, which is right here. The expected return on a particular asset is a combination of the risk-free rate plus beta times the return on the market minus the risk-free rate. So beta is a sensitivity to the market factor. So if we have a beta of 2, a particular stock has a beta of 2. If the market is up 5%, we would expect our stock to be up 10%. That's what a sensitivity means. And the return on the market minus the risk-free rate is an excess return over the risk-free rate to equities. It's called the equity risk premium. It is a risk factor. So the ERP, if it were, let's say, 6%, that would be the risk factor return. It is a risk factor measuring systematic or market risk. And this is our expected return in equilibrium. So what this means is that if the financial markets are in equilibrium, then the return, the expected return on this stock should be fully explained by the return on the market and the risk-free rate. Since asset-specific risk can be diversified away, it should not be rewarded. So when we want to determine what the expected return on a particular asset is, we would not determine what its asset-specific contribution would be. We would say, listen, we can diversify that away, and since it can be diversified away, the market's not going to reward it. It's only going to reward what cannot be diversified away, which is systematic risk. So we just have to figure out what our sensitivity is to the market, figure out what the market return is going to be, which is typically fairly constant with an equity risk premium, and we can calculate an expected return. What is wrong with that? That's a single factor model. Why do we have to go to multi-factor models? It's because capital asset pricing model is an incomplete description of risk since anomalies exist. What we find if we price out expected returns with small cap stocks using capital asset pricing model is it consistently underestimates what the expected return will be. So that's an anomaly. It doesn't account for all of the expected return. Small cap outperforms large cap. Well, that's not caught by a single factor, just the equity risk factor. Value outperforms growth, and I'll say more about this later on. And momentum exists, where last year's winners tend to be next year's winners and have an expected return greater than what CAPM would say. So what do we need? We need more factors. Therefore, add more factors. That brings us to a multi-factor model. We go from a single factor model, which is CAPM, to a multi-factor model, which means we're just going to add another beta plus another factor plus another beta plus another factor, and we can add as many factors as we want. And the types of factors can be macroeconomic factors or fundamental factors, and we'll look at a macroeconomic multi-factor model and a fundamental multi-factor model. All right, let's begin introducing arbitrage pricing theory. For this, we're going to need a model, and we may as well introduce a multi-factor model now, a very generic multi-factor model, and here we are. RI, our expected return. By the way, if we look at this first part right here, and this F1 here was the equity risk premium, that's nothing more than the capital asset pricing model. We're just adding more factors. So let's go through each one of these. RI is the return to asset I in equilibrium. I'll talk about equilibrium again in a second. The intercept is the expected return on asset I if all the factor premiums that we select are 0. So if all the independent variables, which are the factors themselves, are 0, then the intercept will be the expected return on the asset itself. Now, it's not realistic that all the factor premiums would be 0. However, when we get to a macroeconomic model, the way it is structured, it is realistic that all the factors would have a value of 0, such that the intercept is interpreted as the expected return on asset I. We'll see that shortly. So it's not an unreasonable statement to make. The F variables here, these are risk factor premiums. This is the return to that particular risk factor, return to factor I. And the big thing that we're pointing out here is the correlation between these factors is 0 for all possible pairs, for all possible correlations. So if we have 3 factors, all the pairwise correlations between the 3 factors would be 0. And then we have an error term. Sometimes the error term is just an error term. Sometimes the error term has meaning, and we'll dive into that when we get to it. Let's talk about this equilibrium. Let's say that we can model the return on a particular asset with a number of factors, and we have a complete model. That this model does describe the return series that we're looking at. And because we can diversify away asset-specific risk, the model is predicting what the expected return on that stock will be only in financial market equilibrium. That means that the market is pricing that asset correctly. And arbitrage pricing theory ensures that it is. When we look at derivatives, we talked about pricing derivatives out. If you haven't been there yet, that's okay. But when we talked about how we price derivatives out, we use a no arbitrage argument to price out the derivative, such that no arbitrage exists, because if it did, the market would step in and correct it by buying or selling. Well, arbitrage pricing theory says the same thing, that if we have a complete multi-factor model that describes a return series, then the expected return to asset I would be what it is, because if it wasn't arbitrage, there'd be arbitrage opportunities to buy low and sell high, and thereby force it to be. We'll see on the next screen what we mean by that, and then talk about the difficulty of moving arbitrage pricing theory into arbitrage pricing practice. We can also describe this model in terms of excess return. Instead of the return to asset I, we could talk about excess return by subtracting the risk-free rate from both sides. If you subtract the risk-free rate from both sides, you get an excess return on this side, and you only subtract it from one factor on this side. It doesn't subtract from all the factors. And I think that makes sense. If you have 6 equals 1 plus 2 plus 3, and you subtract 1 from both sides, you get 6 minus 1 equals 1 plus 2 plus 3 minus 1. You would not get 1 minus 1 plus 2 minus 1 plus 3 minus 1. You would not subtract the risk-free rate from every factor. It would only subtract from one factor. Typically, that factor will be the equity risk premium. For equities, I think it would be difficult to imagine a multi-factor model that did not include the equity risk premium. Let's look at some of the assumptions behind arbitrage pricing theory. And it's a really short list, which sort of makes it appealing. And they're not unrealistic. Number one, a factor model describes asset returns. In other words, we can create a multi-factor model, and it doesn't specify how many factors, it just says one exists. That we can find a model with enough factors that does describe the asset's return. Number one, we have to accept that a factor model will work. Number two, with many assets available, investors can form well-diversified portfolios that eliminate asset-specific risk. And if it eliminates asset-specific risk, it will not be rewarded by the market, which means all you need are the factors that would describe the expected return. And number three, no arbitrage opportunities exist among well-diversified portfolios. This is just a condition of financial market equilibrium. If arbitrage opportunities existed and you had perfect markets where people could step in and buy low and sell high, they would eliminate or trade away the arbitrage opportunities such that everything would be priced based on its exposure to specific factors and the return to those factors. This is the problem here. In theory, that's really nice. But in practice, that becomes very difficult to do. We'll look at it on the next screen. So if all those three assumptions hold, we can move from describing the return series to forecasting the return series. The expected return on any portfolio would be described by some multi-factor model, and the choice of factors that we select, or the number of factors we select, is up to us. There would be no portfolio alpha. because we would diversify away all asset-specific risk within the portfolio such that the return, the expected return, is completely described by the set of factors. Let's look at example 1 and example 2. Okay, example 1, determining the parameters in a one-factor APT model. And one of the premises here is that all three of these portfolios' returns can be completely described by exposure to this one factor. It is a complete model. Suppose we have three well-diversified portfolios that are each sensitive to the same single factor. Exhibit 1 shows the expected returns and factor sensitivities of these portfolios. Assume that the expected returns reflect a one-year investment horizon. To keep the analysis simple, all investors are assumed to agree upon the expected returns of the three portfolios as shown in the exhibit. So we have ABC, we have our expected returns for each of these, and we have our factor sensitivity. We should find that there is no arbitrage opportunity, that all of them are priced correctly. We can use these data to determine the parameters of the APT equation. According to equation 2, for any well-diversified portfolio and assuming a single factor explains returns, we have the expected return on the portfolio is the risk-free rate plus, and they use a lambda 1 instead of an F for the factor. This is just a factor return, and the beta, and this is just the sensitivity of the portfolio to that particular factor. The factor sensitivities and expected returns are known, and thus there are two unknowns, the parameters RF and lambda. So we don't know what RF is, we don't know what lambda is, but we know what our expected return is, we know what the factor sensitivity is. And if we have two unknowns and we can create two equations, we can always solve for it, right? High school math there. Because 2 points to find a straight line, we need to set up only two equations. Selecting portfolios A and B, we have the expected return on A, which is 7.5%, is equal to RF plus 0.5 times the factor return. Our factor sensitivity is 0.5. And the expected return on B, we just do the same thing. Well, we expect 15%, and it'll come from the risk-free rate plus 2 times whatever the return for the factor is. And all we have to do is just express the first equation in terms of RF, substitute that in down here so we have nothing but lambdas, the factor returns because we only have one factor, and solve. From the equation for portfolio A, we have a risk-free rate equals, and this is just algebra, we're just rearranging it. Substituting this expression for the risk-free rate in the equation for portfolio B gives us nothing but lambdas and knowns. So we have constants and lambdas, well, collect the like terms and solve, and what are we going to get? 0.05%. So the factor return is 0.5%. And once we have the factor return of 0.5%, we can substitute, 0.05%, we can 0.05, 5% or 0.05, there we go. We can substitute back into the expected return for A and solve for the risk-free rate. Doing that gives us a risk-free rate of 5% as well. So the risk-free rate is 5%, and the factor premium for the common factor is also 5%. The APT equation is, expected return on the portfolio is the risk-free rate plus, there's the factor return, 5% times the sensitivity. So we should be able to price out any well-diversified portfolio now that we have a model that describes asset returns. So if we had another portfolio, we should be able to determine what its expected return is. This will lead us into equation 2. So for C, notice it's 7%. We know that A and B, there are no arbitrage pricing opportunities because they are priced correctly. Let's see if C is priced correctly. Expected return of 7%. Let's see if the model will give us that. It's 5% plus 0.05 times its sensitivity, which is 0.4. We get 7%. That means C is priced correctly. Example 2 is going to introduce portfolio D, which we have to test whether or not it's priced correctly. In this example, we examine how to tell whether expected returns and factor sensitivities for a set of well-diversified portfolios may indicate the presence of an arbitrage opportunity. Exhibit 2 provides data on 4 hypothetical portfolios. The data for A, B, and C are repeated from Exhibit 1. Portfolio D is a new portfolio. The factor sensitivities given relate to a one-factor APT model, which we solved in, or which we arrived at in Example 1. As in Example 1, all investors are assumed to agree upon the expected returns of the portfolios. The question raised by the addition of this new portfolio D is whether the addition of this portfolio created an arbitrage opportunity. If a portfolio can be formed from A, B, and C that has the same factor sensitivity as D, but a different expected return, then an arbitrage opportunity exists. So let's just have a look at D. Expected return 8%, factor sensitivity of 0.45. Well, we don't have another factor sensitivity of 0.45. We have a 0.5 and we have a 0.4. We know that 0.45 is midway between 0.4 and 0.5. So mathematically, the easiest thing to do is take half of A and half of C. We don't have to. We can take A and B. We can take B and C. We can take A, B, and C, but that's hard to do. It's easier to do it with 2. And to solve the weights for it, we can say the weighting on A is W and the weighting on B is 1 minus W, and just solve for W, and we can do that. But it's just, I see 0.45, I see a 0.4 and a 0.5. It's midway between the 0.4 and the 0.5, so let's weight A and C 0.5 and 0.5, which is what's done here. If you do that, and you use this this equation that we did in, or arrived at in example 1, you get 7.25%, but it's expected to return 8%, so it must be underpriced, right? How do you get a higher return on something? You buy it at a lower price. That's the only way to get a higher expected return. So it must be underpriced if it's going to return 8%. So what do we do when there's arbitrage opportunity? We buy low and sell high. Since D is priced too low, we would buy D and we would sell half of A and half of C. So if we sold $1 of D, if we bought $1 of D, we'd sell 50 cents of A and 50 cents of C, and that would be arbitrage. Exhibit 2 gives data for an equally weighted portfolio of A and C. The expected return and factor sensitivity of this new portfolio are calculated as weighted averages of the expected returns and factor sensitivities of A and C. And it concludes that we get to 7.5, the factor sensitivity being 0.45. It's just showing that the factor sensitivity of A and C is 0.45. Notice the factor sensitivity of 0.45 matches the factor sensitivity of portfolio D. In this case, the configuration of expected returns in relation to factor risk presents an arbitrage opportunity involving portfolios A, C, and D. Now, what we have to point out here is this is in equilibrium and it's theoretical, because there may be another factor for D. There may be missing factors in this model. It may not be complete. And even if it was complete, there may be something very specific to the types of assets in portfolio D. Now, one of the conditions is that A, B, and C are well-diversified portfolios. But still, in practice, it would be very difficult to do this because, well, what's the definition of a well-diversified portfolio? How many stocks do you need in a well-diversified portfolio? Are you sure there isn't another factor that explains a potential difference that wasn't in A, B, or C? So in practice, not so much. But we don't need it to work in practice. We just need it to work in theory. If we can understand that, listen, a group of factors may explain returns better than a single factor, why not use it? And we're going to see some uses of multi-factor models after we introduce several of them. So there's example 1 and 2. All right, let's introduce the Carhart model. And on a previous screen, I said that rather than using the multi-factor model to determine the return on an asset, we can think about it as excess return, which is what the Carhart model does. The return on the portfolio minus the risk-free rate equals our intercept, plus we have 4 factors. This is the return on the market minus the risk-free rate. Remember, I said if we subtract the risk-free rate from this side, we only subtract it once from the other side. So typically it's subtracted from the market itself, such that we're only looking at the excess return on the market over the risk-free rate. We have small minus large, high minus low, and winners minus losers. All of these are uncorrelated with each other. There is no correlation between small minus large and the market itself, because the betas of these portfolios are set up to hedge out all of the other factors. So let's, and I think it's important to know this model because you will see it at level 3. It is used at level 3. So I think we should understand, and these are very common factors, by the way. I think we all get the equity risk premium because it's CAPM, right? The return on the market minus the risk-free rate. But small minus large, the size factor, and high minus low, the value factor, are very, very, very common. You really should know these and how they're constructed, and we should be familiar with momentum as well. So RF is the return on a value weighted index minus the 1 month T-bill rate. By value weighted, it just means market cap. It doesn't mean it's not an equally weighted index. It's just a market cap weighted index. That's what value weighted means. And this is important, right? Minus the 1 month T-bill rate. SML, it's the average return on 3 small cap portfolios. So you have 3 small cap portfolios, and you'll take the average of those 3, and you will subtract the average return on 3 large cap portfolios. So you'll have 3 large cap portfolios, you'll take the average, and it's the small cap average minus the large cap average, and that is the factor return. And it's important to recognize this: the beta of the small cap portfolios minus the beta of the large cap portfolios must be 0, because beta is already captured in the equity risk premium. What we want to do with small minus large is only capture size. We don't want any market premium in there whatsoever. So the portfolios are structured such that the beta of the small cap portfolios minus the beta of the large cap portfolios equals 0. We have no market risk. And if that's the case, then the return on this factor is uncorrelated with the return on this factor. HML is the average return on 2 high book value to market value portfolios minus the average return on 2 low book value to market value portfolios. And again, it's structured such that the betas of the high book value to market value portfolios minus the low ones equals 0, because we want to take out any market risk because it's already captured by this factor. The question has always been asked is, hang on a second, how is value getting a higher expected return? Wouldn't that mean that value is riskier than growth? Yes, that's exactly what it's saying. Keep in mind, if you have a company where the book value and the market value are identical, let's say that the market prices this company for no more than its book value, so that book value to market value equals 1. What is the market saying? It's offering no or little premium for management, no premium for strategy, or for the business model. The market is looking at this and saying, we're not pricing this at any premium above its book value, because chances are this is all this company is worth, is the value of its assets or the value of its residual assets. If you take out liabilities, asset minus liabilities equal equity, let's price it at book value per share. All companies on their way to financial distress go through a high book value to market value ratio, which means when you are buying in the value pool, there is that value trap that just because something has a high book value to market value doesn't mean it's undervalued. It could potentially be overvalued because it's on its way to financial distress. Whereas growth stocks, the book value to market value is very low, which means there's a big premium in the market value over book value for execution, for management, for business strategy, for the strength of the cash flows, for the growth in those cash flows. Well, that's less risky to be in. So in case you've ever wondered why this is suggesting that value is riskier than growth, we think of value in the sense of stable, mature companies with very strong cash flows and low PEs. Well, that's good value, but this is value as a whole. It doesn't distinguish between good value and bad value. So when it's just one big bucket, yeah, it's riskier. And WML, winners minus losers, is the past 12-month winners. In other words, the top 30% of last year's winners minus the past 12 months losers, the bottom 30%. And again, the betas are structured so that they will equal 0 because you can't have any correlation with the market factor. So you end up with all 3 of these being uncorrelated with each other. Since a well-diversified portfolio can reduce or diversify away asset-specific risk, we know that that is not rewarded. So our expected return in the Carhart model, we can assume that the expected alpha of the portfolio equals 0. The expected return is the risk-free rate plus our return from the particular factors. Why do we have a risk-free rate here? Remember, we had the return on the portfolio minus the risk-free rate equals alpha plus the sum of these terms. Well, alpha is going to be 0, and all we did was we moved the risk-free rate back to that side. There's your complete model. We're going to use this a little later on when we look at return attribution for a portfolio. We'll see how well the Carhart 4-factor model describes a return series. Let's introduce different types of multi-factor models first before we go to looking at different applications. When would we use these particular models? We'll introduce 3 models here. We're on LOS-D. Earlier I had said we were on LOS-A. We did LOS-A, but we also did B and C at the same time. So let me just read B and C so you know what we've done. B was define arbitrage opportunity and determine whether an arbitrage opportunity exists. We did that with example 1 and 2. And C, calculate the expected return on an asset given an asset's factor sensitivities and the factor risk premiums. We did that in example 1 and 2 as well. So we're on D. Describe and compare macroeconomic factor models, fundamental factor models, and statistical factor models. And we'll talk about all 3 here, but going forward, we're really only going to talk more about number 1 and 2, the macroeconomic and the fundamental factor models. Statistical factor models are very difficult to work with, so this reading doesn't even bother with them. A macroeconomic factor model, the factors are surprises in macroeconomic variables. So there is an expectation for inflation, let's say, of 2%. And if inflation comes in at 2%, the factor would be 0 because there is no surprise. It is returning exactly what it expects. Remember earlier I said that we can interpret an intercept as the expected return if all factors equal 0? Well, this is where all factors would equal 0 is a macroeconomic factor model. If all economic data comes in as expected, well then it all should have been in the price, which means the intercept is the expected return on the asset. We'll see more of this a little later on. Common factors, interest rates, inflation, business cycle risk, and financial leverage. This is financial leverage at the level of the economy. Factors that affect cash flows or discount rates. We know that the price, P naught, if we're calculating intrinsic value, V naught equals a series of cash flows discounted. And of course that continues on. So the only time you can affect the return series is if you affect price, and you can affect price by affecting the cash flows or by affecting the discount rate. And this works for both bonds and equities because bonds have a series of payments discounted by a risk-free rate plus, if they're credit risky bonds, some credit spread. Fundamental factor models. Here we're using attributes of the stock itself or of the security itself or of the company. Things like book value to market value, market cap, PE ratios, and financial leverage. And this is leverage of the individual company, whereas this is leverage at the level of the economy. Statistical models applied to historical returns to extract factors. And the factors are very particular. The factors are a weighted combination of the securities in the portfolio. So let's say we have a portfolio of 3 securities, A, B, and C. The first factor will be some weighting of A, B, and C. The second factor will be some weighting of A, B, and C. They will be uncorrelated, but they are super, super difficult to interpret. What does this mean? A, B, C. So we have these 3 securities, and this is the first factor finds that this weighting creates one factor. Well, what does that factor mean, right? It becomes very difficult to interpret. And some methods for statistical models here, we can use factor analysis or principal component analysis. And that's as far as we go on this. As long as you understand that the factors we arrive at are weighted, are just weighted components of the original portfolio. That's as far as the factor will go. It will not go outside of the portfolio to look for things. It will just weight the assets in the portfolio in a particular way and call that a factor. Okay, let's look at fundamental factor models first and look at the structure of these models. And this is basically everything that we've looked at so far. It's the same form. The F's are factors, and the factors here are returns. The betas are different. The betas are standardized, and they're calculated first. Typically, when we're doing a regression on factors, is we have the return series that we're interested in, and we have the return series for all of the factors, and then we'll use regression, and regression will tell us what the sensitivities are. We'll get our weightings on each of the betas. This way here we start differently. We calculate our betas first. Once we have our betas, we use regression to determine what the factor return was. So betas are standardized. They're calculated first except for binary variables. For binary variables, you'll either have a 0 or a 1 as a beta. So how do we standardize? Well, level 1 quant, right? How do we standardize any variable? It is the observed value minus the mean over the standard deviation. Same thing here. The value of attribute k for asset I, because there are k factors, so whatever factor it is, the value of attribute k minus the average value of attribute k over the standard deviation of the values of attribute k. So let's say it was PE. And the stock that we're looking at, or the company we're looking at, is a PE of 16. The average of all companies is 14, so it'll be 16 minus 14 over. And let's say it ranged from 30 down to 6. Well, you know how to calculate a standard deviation. Let's say we got a standard deviation of 4. It'd be 16 minus 4 over 4, 2 over 4, 0.5. There's your coefficient. So all your coefficients are calculated first, then regression is used to calculate the factor return. So how we can look at this, a stock with an average value on attribute K will have a beta of 0. So let's say that instead of 16, it had an average value. Well, 14 minus 14 is 0. The beta would be 0. A value on attribute K, one standard deviation above the average, will have a beta of 1. So the standard deviation was 4. Let's say that this was 18 instead, right? It's one standard deviation above the average. 18 minus 14 is 4 over 4 equals 1. That's how we see a beta of 1. We know it has an attribute, a value of an attribute that is one standard deviation greater than the average. Kind of gets a little bit difficult to interpret because you have to think in terms of deviations from an average. Factor sensitivities are calculated first. Factor returns are then calculated through regression. Within a fundamental factor model, the factors can be company fundamental factors. These would be related to internal performance, like earnings growth, earnings variability, earnings momentum, or financial leverage. They could be company share related factors, valuation measures, factors related to share price or trading characteristics. So our earnings yield, dividend yield, book value to market value. Or they can be macroeconomic factors, typically sector or industry membership. These are our binary variables here. Fixed income factor models. We can use not just on equities, but we can use them on fixed income as well. A macroeconomic model. Here are two factors here. One with inflation, a factor, risk factor for inflation, another risk factor for GDP growth. They could be fundamental factors like duration, credit, the currency of the bond, the geography of the issuer. And the reading gives an example of one with 6 particular factors. Our factors are short-term government bonds, intermediate-term government bonds, long-term government bonds, investment grade and high-yield bonds, and mortgage-backed securities. And these are will all be estimated with something called a constrained regression. That means that the sum of all the sensitivities, all the betas, must equal 1. And if we have something like that, and I give you a return series, and you regress it on these factor returns, you'll have a return series for each one of these, and you do a regression, you will get loadings on all of these coefficients, and the sum of them will equal 1. You should be able to say, okay, the return on this portfolio was derived, a certain percentage was derived from government short-term bonds, intermediate term, long-term, or exposure to that particular factor. So by looking at a return series, and if you have a factor model, you can attribute some of that return to having exposure to some of these factors. So I don't have to look at your portfolio. I can tell a lot from your portfolio by the variability of your return series. With the variability of the return series of these factors will give me betas, which will tell me how much of your return was derived from exposure to a particular factor. Let's take a walk through example 3 and 4 now. All right, we'll use the model 2 different ways. Example 3 has the model and just asks you to calculate an expected return for a portfolio. Example 4 says, hey, given the sensitivities of the betas of this particular portfolio, is it following its mandate? So let's look at 3. A fixed income portfolio has the following estimated exposures: 35% intermediate government bonds, 40% investment grade credit, and 5% securitized, 20% high yield. When it says investment grade credit, that means risky bonds. They are not government bonds, they are corporate bonds. The expected component returns are short-term bonds, 0.25, intermediate. We have all of the returns. Express the expected return of the portfolio. Well, it's telling us what our exposures are. 35% intermediate government bonds, and intermediate government bonds premium is 1.5. So this 35% is our beta, it's 0.35. Remember, we have a constrained regression. Our betas must sum to 1. Let's see if this sums to 1. 35% and 40 is 75, and 5 is 80, and 20 is 100%. So on intermediate government bonds, our beta is 0.35. On short-term government bonds, our beta is 0. So we just have to add the variables that we need, which is done here. 0.35 of the 1.5, 0.4 of the 4.25, that's investment grade credit. 0.05 of the 1.75, that's MBS or securitized, and 20% high yield at 5.75. Expected return is 3.46. The expected return to the portfolio, by maintaining exposure to those risk factors, we would expect a return of 3.46%. For example 4, reconciling bond portfolio characteristics using style factors. Talia Ayalon is evaluating intermediate duration investment grade fixed income strategies. Intermediate duration, that's between 5 and 7 years, investment grade fixed income strategies using the framework presented in Exhibit 4. One of the strategies has the following sector attribution. So let's first of all see what we have. 2% and 4 is 6, plus 14 is 20, and 56 is 76, 6 is 82, 18 is 100. So these are our betas. This is, if we take the return series of the portfolio we're looking at, we can say, look, 2% of your return can be explained by having exposure to short-term government bonds, 4% from intermediate bonds, and 14% from long-term bonds, 56% from investment-grade credit. You say you're an intermediate duration investment-grade fixed income strategist. Investment grade's only accounting for 56% of your return. You've got MBS and securitized in there for 6%, which is okay because you can get AAA mortgage-backed securities. That's investment grade. But high yield, that is not investment grade. That is exactly opposite investment grade. 18% of your return is from high yield. And I see over here 14% from long-term government bonds, which is not intermediate term. When we say intermediate investment grade, well, government is investment grade. We have investment grade here. MBS can be investment grade, but high yield can't. And the short and the long end of the curve is not intermediate. So are you drifting from the style that you say that you have? You say you're an intermediate duration investment grade fixed income portfolio, or that's the strategy that you're following, but your return attribution tells a little bit of a different story. What it's saying here is that if I have these types of exposures, I can create another portfolio with these types of exposures, I can replicate your return. And if I can do this to replicate your return, something's going on here. If I can allow high yield in here and the long end of the curve to replicate your return, you must be getting some of your return from those sources as well. Are these sector exposures consistent with an intermediate duration investment grade approach? Why or why not? No. The sector exposures are inconsistent with the stated approach for two reasons. Number one, the 18% exposure to high yield constitutes a significant amount of below investment grade exposure. Yes, a true investment grade portfolio would, for example, not have exposure to high yield. The loading to longer duration sectors implies a longer than intermediate duration for the portfolio. You can sort of let this slip. And I think you can let the MBS go as well because, again, you can have AAA. You can't let high yield slip because it's the opposite of investment grade, and going long on the curve is reaching for yield, is not staying intermediate. All right, let's have a look at macroeconomic factor models now. And the expression of the model looks like it's always looked throughout this reading. It's just the interpretation of the variables are a little bit different. Let's start with the factors. The factors are surprises. It's not a return series, and it's not the value of a variable. It's the surprise in the variable. So it's actual minus predicted. So if we think about inflation, and if we are predicting 2% inflation, and actual is 2.5%, then the factor would be 0.5. If it comes in at 2%, the factor has a value of 0. And if all the economic data in our model come in as expected, all the factors would be 0. And remember earlier in the reading I said if all the factors are 0, then the intercept can be interpreted as the expected return on the asset. Well, that works in macroeconomic factor models. The expected return on asset I if all factors are 0. And what this is saying is that the expected return from the asset incorporates the expected value of the macroeconomic factors. So if we have 4 factors and there's a prediction of what the values will be on the 4 factors, the market will price that prediction in. And if everything comes in as predicted, then the asset is fairly valued because the market already priced that in. The error term also has meaning as well, because now these are macro factors. Well, you're not going to get rid of asset-specific risk. That'll be picked up in the error term. Asset-specific risk, this is not misspelt, IFF, means if and only if. If and only if the model adequately represents the sources of common risk for the particular asset. If it does, then the error term will pick up asset-specific risk. If it doesn't, let's say that we're missing a factor that should have been in there, then the error term will pick up asset-specific risk plus it will have missing variable bias in it as well. It won't just be asset-specific risk. That's not a big thing, by the way. That's just a little technical detail that I'll make you aware of, that the error term contains that kind of information, but I wouldn't hurt myself in trying to wrap my head around it if you don't get it. Don't worry about it. One thing I will unlock for you here is within the reading, there is a model given that includes GDP and inflation, and then it has a little paragraph about the return to inflation, or the factor. The return to the inflation factor is typically negative. For GDP growth, it's typically positive, so that if you have a plus sign in front of your beta, you have hedging inflation ability, and that sort of causes confusion. So let me see if I can unpack that for you. The risk premium for GDP growth is typically greater than 0 because assets respond well to GDP growth. The risk premium for inflation is typically less than 0 because assets typically respond negatively to increased inflation. So that if we have 2 particular assets, let's say the return on I and the return on J, described by these factor models using inflation and GDP only, the only difference is I has a plus sign in front of the beta coefficient, J has a negative sign in front of the beta coefficient. This is saying that as inflation comes in higher, asset J's returns will be hurt. Before we even jump into the models, just looking at I and J, all else equal, the required return on asset I will be less than the required return on asset J. In other words, if we had 2 assets and one did offer inflation hedging ability and one did not, their intercepts would be different to begin with, and asset I's intercept would be lower than asset J's. It would have a lower required rate of return because it would be in demand for its inflation hedging ability. Keep in mind the factor, this inflation here, is not inflation. It is the surprise in inflation. So if something has inflation hedging ability and inflation comes in higher than expected, the expected return should increase. That's what inflation hedging means. Whereas if it doesn't have it, the expected return should decrease. So if inflation is greater than 0, in other words, actual minus expected is greater than 0, the expected return on asset I will increase. The expected return on asset J will decrease. That's all that thing was saying. It's talking about required return, and the model is calculating expected return. Required return is captured in here. And if everything comes in as expected, the required return will be the expected return. Okay, I just wanted to clear that up because in previous years that amounted to a whole bunch of questions about how to unwrap that. And you have to understand that that paragraph was talking about required return, not expected return, and that the factor itself is the surprise in inflation, not the measure of inflation. Let's walk through example 5 and example 6. Okay, example 5 uses the 2 factors we just talked about, GDP and inflation. Suppose that stock returns are affected by 2 common factors, surprises in inflation and surprises in GDP growth. A portfolio manager is analyzing the returns on a portfolio of 2 stocks, Manumatic and Nextech. The following equations describe the returns for those stocks where the factors for inflation and GDP represent the surprise in inflation and GDP growth respectively. And here are the two models. Notice we have a plus sign in front of Nextech here for the beta in front of Nextech, which means that inflation comes in higher than expected. It's going to push up the expected return for Nextech, but it's going to affect Manumatics. It's going to lower the expected return. 1/3 of the portfolio is invested in Manumatic stock. 2/3 is invested in Nextech. Formulate an expression for the return on the portfolio. Well, these are individual stocks within a portfolio. We know that 1/3 of our money is in Manumatics and 2/3 are in Nextech, so we just have to weight it, which is exactly what it does. 1/3 times the intercept plus 2/3 times the other intercept plus 1/3 times the beta factor plus 2/3 times the other beta factor times the factor itself. The factor itself is common to both, right? So even if you weight it, it would be 1/3 times the factor plus 2/3 times the factor, which is just one factor. So the only weighting that we're doing is on the betas. And same thing with GDP. And notice that the error terms cannot be added together because they are distinct. So it's 1/3 times the asset-specific risk for Manumatics plus 2/3 the asset-specific risk for Nextech. There's your equation once you collect the terms. State the expected return on the portfolio. This is from an earlier learning objective, which is, given a factor model and given the returns to the factors, what's the expected return on the portfolio? The expected return on the portfolio is 11%. How did we know that? We weren't given anything else to go on. Can you figure that out before I give it to you? This is a macroeconomic factor model where the factors are surprises. What is the expected return? Well, if all of the data come in as expected, the expected return is in the intercept, and we've calculated the intercept to be 0.11. Careful with that, right? The expected return on the portfolio is 11%. The value of the intercept in the expression obtained in the solution of 1. And number 3, calculate the return on the portfolio, given that the surprises in inflation and GDP growth are 1% and 0% respectively, assuming that the error terms for Manumatic and Nextech both equal 0.5. So we have a 1% surprise in inflation, but no surprise in GDP. Well, all we have to do is just enter it in. INFL is 0.01. So 0.11 plus 1 times that. This is still 0 over here because it came as expected. You still have your asset-specific risk. We have 12.5%. Does it make sense that we have 12.5%? Inflation came in higher than expected. Notice what we have in front of inflation here. We have a plus sign, which means we have a portfolio with inflation hedging ability. If inflation comes in hotter, inflation hedging ability means it should give us that return, and it does. So we have 12.5% versus 11% because inflation came in higher than expected. And we also had some extra asset-specific risk on both of them. They were both equal to 0.5. So if it's 1/3 of 0.5 and 2/3 of 0.5, we have 0.5. So we went from 11 to 12.5% because we had a 1% surprise in inflation, which should give us 1% because we have a sensitivity of 1 for it. And we have 0.5 or 50 basis points on each of these asset-specific risk to get to 12.5. Okay, example 6 is just a discussion of a research paper that was done comparing macroeconomic and fundamental models in explaining returns. And there are some interesting conclusions here that I've highlighted that I think we should pay attention to. Connor contrasted a macroeconomic factor model with a fundamental factor model to compare how well the models explain stock returns. Connor reported the results of applying a macroeconomic factor model to the returns for 779 large-cap U.S. stocks based on monthly data from January 85 through December 93. All right, 779 stocks. We have the time period. We know what we're doing. We're going to construct a fundamental model and a macro model, and we're going to compare them. Using 5 macroeconomic factors, Connor was able to explain approximately 11% of the variance of returns on these stocks. You may think 11% is low. In social science research, 11% is big. This is not physics, by the way. So we got 5 factors that explain 11% of the variance. Meanwhile, common sense and just thinking things through logically could probably get you 50% of the way there. So your brain is better than these models, I think. Anyways, there's 10.9%. We can see the factors that were used, the explanatory power of using each factor alone and then using them in combination. Let's keep going here and let's look at the fundamental factor model. Look how big one of them here is. Industries. Just this one alone is 60% more explanatory power than all 5 of the macroeconomic factors, just knowing what industry something is in. And all of these factors together, 42.6. But you got a long list, right? But 42.6, that's a lot better than 11%. There were 55 industry dummy variables that were used in this as well. Much more complex models. I'm just going to read the highlighted portion, right? Typically, fundamental factor models employ many more factors than macroeconomic factor models, giving a more detailed picture of the sources of investment managers' returns. And we'll start reading from this paragraph here. The 2 types of factors, macroeconomic and fundamental, have different implications for measuring and managing risk in general. The macroeconomic factor set is parsimonious and allows a portfolio manager to incorporate economic views into portfolio construction by adjustments to portfolio exposures to macro factors. That's the big deal. It's a small list of variables. It's parsimonious, but it doesn't really explain a lot. The fundamental factor set examined by Connor is large, 67 variables, 55 industry dummy variables. At the expense of greater complexity, it can give more detailed picture of risk in terms that are easily related to company and security characteristics. And this becomes important. Connor found that the macroeconomic factor model had no marginal explanatory power when added to the fundamental factor model, implying that the fundamental risk attributes capture all the risk characteristics represented by the macroeconomic factor betas. So if you have a macro model and a fundamental model, what this research has said that, hey, listen, if you think that they're both good and you just add them together, you'll find that above what the fundamental model can do, the addition of the macro factors don't explain anything because they're already explained by the company factor premiums. And that's really all that it was pointing out, was just sort of comparing the two along a couple of things that we can take out. Number one, the macro model is far more parsimonious, less complex, but also less explanatory, and added to a fundamental model doesn't really improve the ability of the model to explain sources of returns. All right, so now we know what a multi-factor model is. We've been introduced to macroeconomic and fundamental multi-factor models. Let's look at what we would use them for. And there are 4 broad applications that we'll look at in this particular reading. Return attribution, risk attribution, because if you can attribute return, you can attribute risk. Portfolio construction and strategic portfolio decisions. Return attribution and risk attribution you're going to see again at level 3. This is a nice introduction to what it looks like. So you might want to perk your ears up a little bit more here. Let's look at the learning objectives we're covering. LOS, E, and F. E is explain sources of active risk and interpret tracking error and the information ratio. That is in conjunction with risk attribution. And describe uses of multi-factor models and interpret the output of analysis based on multi-factor models. That is these 4 that we'll cover here. So return attribution, in this particular reading, we're really just looking at a return relative to a benchmark. You can do an absolute return attribution. In other words, a portfolio that has no benchmark, you can do an attribution of that return based on a number of style indexes to try to determine what style the portfolio was following. But if we have a benchmark, we can do a return attribution on the portfolio to determine what were the sources of active return. And active return is the return above the benchmark. Fundamental models are favored for return attribution. Statistical models, as we said, are too difficult to interpret. And we've already seen in that paper that we looked at in one of the previous examples that a fundamental model seems to be a lot more explanatory than a macroeconomic model. And even adding macroeconomic variables to a fundamental factor model doesn't improve the model whatsoever. Style choices are simply better reflected in a fundamental model versus a macro model. So fundamental models are typically favored. And we're looking to attribute the sources of active return. If the portfolio tracked the benchmark exactly, it would return exactly what the benchmark returned. There would be no need to do an attribution, a return attribution, because its return would be the same return sources that the benchmark would have. But if we have a return that's different than the benchmark, where did we get it from? And the active return is the sum of two components. The first are factors that are our exposure to factors that are different than the benchmark. So this is the return to the factor. This is the sensitivity to this particular factor for the portfolio versus the benchmark. So it's just the difference in the factor sensitivities times the factor return. We call these factor tilts. So are we getting more or less return than the benchmark by leaning into certain factors? Maybe overweighting small cap stocks, underweighting growth, or overweighting value, leaning into momentum, things like that. And then, of course, there's security selection. Typically, we will know our active return because we'll know the return on the portfolio, we'll know the return on the benchmark. We can calculate this rather straightforward. The difference is security selection. So it's just our active return minus the sum of the first component, and it's a residual. Let's walk through example 7. Four-factor model active return decomposition. As an equity analyst at a pension fund sponsor, Ronald Service uses the Carhart four-factor multifactor model of equation 3A to evaluate U.S. equity portfolios. And it just replicates the model. Service's current task is to evaluate the performance of the most recently hired U.S. equity manager. That manager's benchmark is an index representing the performance of the 1,000 largest U.S. stocks by market value. The manager describes himself as a stock picker and points to his performance in beating the benchmark as evidence that he is successful. So let's just stop right there. If I say, listen, I'm a stock picker and I beat my benchmark, clearly I'm a good stock picker. Can we conclude that just because I beat my benchmark? We're going to see what the factor model allows us to do is to determine, well, hang on a second, you say you're a stock picker and that you beat your benchmark, so you're good. But where did you actually get your return from? If you got your return by just leaning into particular factors that were in favor, we can determine what your security selection amount was by the residual, and then we'll really see if it's true. So you can't just say, hey, I beat my benchmark, I must be good at picking stocks, because it just might be that you had exposure to a factor that just happened to be in favor. That's the power of return attribution, is I can test whether or not you are actually doing what you say you could do. Let's see, Exhibit 9 presents an analysis based on the Carhart model of the sources of that manager's active return during the year, given an assumed set of factor returns. In Exhibit 9, the entry A, return from factor tilts, is 2.1241. Is the sum of the four numbers above it? Oh, well, let's not worry about that. Let's just look at the model. I'll explain it down here. Here's our benchmark, and here's the factor sensitivities to the benchmark. Exposure, the sensitivity of the market is 1, small minus big is -1. When we have a negative coefficient, that means we are leaning towards large cap stocks. So this is a broad-based portfolio because it has a sensitivity of 1 to the market. It's a large cap, broad-based portfolio with no particular leaning towards growth or value, and just almost an insignificant amount of momentum here. Whereas the portfolio, slightly lower on the market, nothing really to be concerned about. Slightly larger than large cap, nothing to be concerned about. Here's the big lean into value. So the portfolio is leaning heavily into the value factor, almost nothing on momentum that's really different from the benchmark. Gives you the differences here. Notice that they're all very small except for value. Here are the factor returns. Notice the negative sign for the factor return for small minus big. This is saying that large cap outperformed small cap. Remember how this factor is formed? It's the return on small caps minus the return on large caps. So if the factor premium is negative, that means large caps outperform small caps, and we leaned into large cap, right? That was our benchmark. So this is the contribution. All it is just the difference multiplied by the factor return, and this tells us how much of our active return came from a difference in the factor exposures to this factor return. Look at this, 2.04 is the big one for high minus low. That basically is almost all of our active return. 98.4% of our active return came from that one decision. Here are the factor returns. Look at this for momentum, 9.63. Had we just leaned into momentum a bit more, we would have done better. But look at B, security selection. So we know what our active return is. We'll know that pretty much right away. And we've just calculated what our factor tilts are. The difference between the two must be security selection. This person claims to be a stock picker and says they're good because they beat their benchmark. Are they a good stock picker? Or did they just happen to be leaning into value when value was in favor? Did they get lucky? Is this just luck? Did they know that value would be in favor? That's the so you have to sort of ask those questions after. But based on this, I don't see skill in stock selection at all. From his previous work, Service knows that the return to growth style portfolios often have a positive sensitivity to the momentum factor. Oh, that's really nothing to do with what we're doing now. By contrast, the returns to certain value style portfolios, in particular those following a contrarian strategy, often have negative sensitivity to the momentum factor. Using the information given, address the following questions. Determine the manager's investment mandate and his actual investment style. Well, the investment mandate is your benchmark, and your investment mandate is broad-based large cap stocks with either no growth or value bias. This manager is pretty much that, but with a heavy value bias. So there's the mandate and the style. Evaluate the sources of the manager's active returns for the year. This is all we're doing down here. If our active return is 2.0741, we look at value because they really leaned into value. Did that work out? It certainly did. 98.4% of our active return is explained from that. What concerns might Service discuss with the manager as a result of the return decomposition? Well, you can always get exposure to a large cap value index. You don't need to pay the manager to get that. You can get it yourself. So if this is all the manager can deliver, you can do it yourself. This guy said he was a stock picker. So you expected that the majority of the active return would have come from security selection. And security selection actually brought down the active return 2.4%. That's your big concern. I hired you as a stock picker. You're looking like you're just giving me the return to an index that I can get. Rather than take a broad-based market index, I can take a large cap broad-based value index. Because every index can be split into value and growth. I could have just done that myself. I didn't need you. So there it is. There's a return decomposition. Next application is risk attribution. And that is just a decomposition of risk into the sources of where a portfolio's risk came from, whether we're talking about total portfolio risk or just active risk. Fundamental factor models are typically used, much like we had in return attribution. Let's define active risk. You'll see more of this in a reading coming up called Analysis of Active Portfolio Management. So this stuff may be new, or the terminology may be new, but if you feel that it's not being covered deeply enough here, it's because you'll see all of this in that reading coming up. So active risk, R sub A is active return. So active risk is just the standard deviation of the active return, and the active return is the return on the portfolio minus the return on the benchmark, also called tracking risk or tracking error. You might see it as TE. And to visually get in your mind what active risk is, let's go back to level 1, and there's our risk-free rate. And there's our capital allocation line. Here is our efficient frontier. So this is how we pick an optimal portfolio of risky assets. The slope of this line is the Sharpe ratio, which is the return on the portfolio, return on the portfolio minus the risk-free rate over the total risk of the portfolio, standard deviation of the portfolio. When we're talking about active risk, we draw the same thing, except this is now the benchmark return, and we draw a line out from the benchmark return. Since we're starting at the benchmark return, this along here is active risk, and this is active return because it would be the return above the benchmark. So that we move from a Sharpe ratio in total risk space to an information ratio when we're dealing with active risk space. So it's the return on the portfolio minus the return on the benchmark. So if the return on the portfolio is here, we can calculate the slope of this line by rise over run, right? Return on the portfolio minus the benchmark divided by active risk, which is exactly what we have. Well, this term up here is nothing more than active return. So our information ratio is active return divided by active risk. Now that we sort of see where active risk is and what it is in our mind, let's break it down. It is the sum of two components, much like active return was the sum of two components. Now we know what our active return was. We said that on the previous screen. And from that we can calculate how much of our return was due to factors, and the difference is asset specific. Here it's the other way around. We know what our active risk is because we can calculate the standard deviation of our active returns. But it's easier to calculate the security selection risk component first, then the difference must be active factor risk. And how do we get this? This may look complicated here, but what is this term in here? This is just the weighting, an active weighting. That A at the top means active weighting. And active weighting just means weight on the portfolio minus the weight on the benchmark squared. So let's say that we have a portfolio with A, B, and C. And the benchmark weights them 0.33 each. And the portfolio weights at 0.4, 0.4, and 0.2. Our active weights are 0.066, and here it would be negative 0.133. Those are the active weights, and that's what we have in here, and we square them. What is this term over here? That's the standard deviation of the error term. Why are we doing that? Well, we're looking for a specific active specific risk or security selection risk, right? And what do we know about the error term? It is the returns. Within the error term, it'll catch the returns not explained by the factors. So by taking the standard deviation of the error terms, we have the variance of the returns not explained by the factors. And we're using variances here because you can't add standard deviations, but you can add variances. So all we're doing is taking standard deviations and squaring them. So that's why this is squared, that's why that's squared. It gives us a variance. Once we have this, once we know what our active risk is, we can square it, we'll get the variance. Take that minus what we get from security selection risk, and what must be left over is active factor risk. Let's take a walk through example 9. All right, example 9, probably not the best example of a risk attribution. It sort of just gives you the tables without leading you through where they came from. So we're just going to ignore a lot of the narration and just look at some big points. This table is all variances. You see active risk squared is 49, and these are all variances. We can add variances. We can't add standard deviation. So mathematically, it's easy to work with variances, which is why we have it. So this 49 here, we can see of the total variance, 29.4 of the 49 comes from exposure to factors. 19.6 of the 49 comes from exposure to, non-factor return, the variability of the non-factor return. So we have A, B, C, and D. And when we're comparing the two, we note that we have different levels of active risk for A and B. So it's hard to compare these numbers by saying, well, one has more. You have to look at it in terms of proportions. What percentage does this represent of the 49? What percentage does this represent? And once you have it in that form, you can compare them a little bit better, which is what they do down here. So in comparing A and B, we can see that they get the same proportion of their risk from the same sources, 60% from exposure to factors and 40% from exposure to non-factor, variance in the non-factor returns. However, it's the type of exposure to factors that differs between the two, and this is what risk attribution allows you to do, is to break it down. If we just had the 60-40 on both of these, you would say, well, it seems like they're following the same strategy. But when we look at the sources of where the risk is coming from, we see that they are different. This one is interesting, D. Active risk squared is 1. And of course, the sources of active risk are as follows. Total factor risk 0.5, active specific risk 0.5. Very, very low compared to everything else. So when you look at that, what do you think is going on there? It doesn't look like this portfolio is assuming hardly any active risk at all, which means it must be very, very, very close to its benchmark. And if we look at the explanation of D, portfolio D appears to be a passively managed portfolio, judging by its negligible level of active risk. That's the big takeaway from Exhibit 9 is just, okay, so you're given this, how do you then interpret it? And it's just really looking at the where does the variability in our active return come from? Does it come more from factors? And if they come from factors, which factors? Or does it come more from any active specific risk in terms of security selection? Another application of multi-factor models is for portfolio construction. And we'll look at constructing three types of portfolios here: passive, active, and a rules-based active portfolio. So for a passive portfolio, let's say that your task was to replicate the Russell 2000. Well, that's 2,000 securities. There's a lot going on in there. What you may do is a factor decomposition of the Russell 2000 to determine what factor exposures it has, and then select a smaller group of securities within the index that replicate the same factor exposures. So you want to replicate the benchmark factor exposures on a much smaller set of securities. For active management, you can use the models to predict alpha, number one, or you can construct a portfolio with a desired risk profile. And the easiest one to explain would be something called a pure factor portfolio. That means there is a beta of 1 for that particular factor and a beta of 0 for all others. It is a pure factor. Much like size is. Remember in the Carhart 4-factor model we had small minus large. And this was the return on small cap portfolios minus the return on large cap portfolios. And if you sum the two together, you should get a beta equal to 0. In other words, the factor is size, and it is a pure factor portfolio. Rules-based active management, determining when to overweight or underweight specific factors depending on what signals you have in the marketplace. We'll take a walk through example number 10 here. All right, and this one, just like example 9, I'm not going to read every word. We're just going to get the general idea of what's going on. Analyst Wanda Smithfield has constructed 6 portfolios for possible use by portfolio managers in her firm. The portfolios are labeled A, B, C, D, E, and F in Exhibit 12. And these are different factors that she's modeling in them, but we'll just go right to the description here. So risk factor, confidence, time horizon, inflation, business cycle, market timing, and here's our portfolios. And here are the factor exposures that we've achieved. So a portfolio manager wants to place a bet that real business activity will increase, that is business cycle risk for real business activity. Determine and justify the portfolio among the 6 given that would be most useful to that particular manager. So for portfolio A, we get a factor loading there, but we also get a whole bunch of other risk factors brought in with it. We don't want that. B, look at that, we get a factor loading of 1 and 0 on everything else. So if we're really just trying to get exposure to business cycle risk, B is the best one so far because that's all it's getting. C has nothing, so we can ignore that. D has nothing, we can ignore it. E has a 1, but you're also bringing in time horizon risk. And with F, you're getting some business cycle risk, but a whole bunch of others as well. So if we are just looking to place a bet that real business activity will increase, we want to place the purest bet possible. We want to bet just on that factor. That is portfolio B. Would the manager take a long or short position in the portfolio chosen in A? Well, you take a long position, right? Because we're just trying to get exposure to that factor. A portfolio manager wants to hedge an existing positive long exposure to time horizon risk. And we just want to get rid of time horizon risk, right? Determine and justify the portfolio among the 6. Well, let's have a look. Time horizon risk, there's a 1 there, but you're also getting rid of a whole bunch of other things as well. Here's time horizon risk here, and 0 loadings on all the other factors. So if we're just trying to hedge out time horizon risk, we would go short portfolio D because we'd only be removing that risk. If we do it over here in C, notice we're also taking out a whole bunch of other risks that we may not want to. So that's the nice thing about these pure factor portfolios, is then you can start to take long and short positions to get just the exposures you want. What type of position would the manager take in the portfolio chosen in Part A? Well, you would take a short position because you're hedging out an existing long position. And this is just the narration to the answers, which we do not need. There is another box example down here, constructing multi-factor portfolios. I'm not going to go through it. If you've been through the reading, which you probably haven't because it's next, backtesting and simulation, This box tends to make a little bit more sense. It's easier to read. You don't have to stop and think, well, what does this mean? What does that mean? You'll understand a lot of what's going on because it uses some of the output in exhibits that you would naturally get from a back testing or a simulation. I'll leave that to you to walk through, but I do encourage you to walk through that one. Next application we'll look at here is for strategic portfolio decisions. Multi-factor models offer a richer context over single-factor models to improve portfolio selection. So remember level 1, again, let's draw that out. We did this in portfolio management where we had our Markowitz efficient frontier. We had the optimal portfolio of risky assets in here. We had the risk-free rate, and we could determine where on the capital allocation line we want to be by either lending or borrowing, using leverage to get the specific return we want with the specific level of risk, but that we would use a specific optimal portfolio, and it was the portfolio that lied on the highest capital allocation line because this was our Sharpe ratio. Well, when we do that, what we're implicitly saying is there is one risky asset, one factor, which is whatever factor that risky asset portfolio happens to have. But what if we're in an environment where we say, look, I'm pretty sure these types of industries will underperform and stocks with these characteristics will underperform. How can we just get rid of those? And a portfolio designed on multiple factors can help you do that. So it offers a richer context over the single factor model. In other words, we don't have a choice between the risk-free asset and a single risky asset. We can construct portfolios that have just the risk factor exposure that we want or do not want specifically. Allows investors to obtain exposures to risks they are better suited to bearing. So let us say that I am a pension fund and I give an allocation to an equity manager, or let's put it this way, I give it to a fixed income manager who is going to invest in bonds. And I say, I have a very long time horizon, so I'm not sensitive to liquidity at all. So what the portfolio manager can do is design a portfolio that has a lot of illiquid assets in it because I'll get the premium. I can accept illiquidity risk. I'm better equipped to handle that. Well, we can find where you get illiquidity risk by determining what bonds have exposure to that particular factor. So it allows the development of a portfolio with risks not only that I'm willing to accept, but also with risks that I'm better able to accept for whatever reason. All right, LOSG described the potential benefits for investors in considering multiple risk dimensions when modeling asset returns. And there's no section really in this reading that talks about it. It's sort of just points that we collect throughout the reading. So these should be very familiar to you. We can build portfolios that replicate or modify the characteristics of an index in a desired way. And we've seen this in one of the examples where we had a large cap broad-based index and the portfolio leaned heavily into value away from growth. Establish desired risk exposures to one or more risk factors. We saw this in another example where we would use pure factor portfolios to either gain exposure or to hedge out a particular risk exposure. Perform granular risk return attribution. Ensure that active risk and return outcomes are commensurate with active fees. And there was one that we looked at where the individual claimed to be a stock picker, but we saw that the majority, almost 102% of their active return came from factor exposures, and they actually had negative 2.4% from security selection. So if we're paying active fees for that return, we would then have to say, listen, we didn't get what we paid for. We got a lot of factor return, but we didn't get your stock picking return, right? Help investors achieve better diversified portfolios and possibly more efficient portfolios. And that's the example I gave, that rather than looking at one particular risky asset portfolio and designing all portfolios as a combination of a risk-free asset and the market portfolio, we can start thinking of portfolios that have just the risk factors we want without all of the others. And of course, all of these advantages that we have here, or these potential benefits, are versus a single factor model. And that brings this to an end.